We are recording this. Happy Tuesday, everyone, and welcome. I'm Sarah Mahalitz, Senior Director focused on Clean Energy Procurement Acceleration at the Clean Energy Buyers Association, or CEBA. And I am delighted to kick off this conversation with one of the most important drivers of the clean energy transition, corporate demand for clean energy. So first, before we get started, if you don't know CEBA, our goal is to activate energy customers and partners to advance low carbon, reliable, carbon emissions-free global energy systems. And our members comprise 1/5 of the global Fortune 500. So that's more than $33 trillion in market capitalization, and includes energy customers and other stakeholders in the energy transition of all different types and sizes. Carrie, could you go to the next slide, please? So our goals for this conversation today are to explore and define the impact of corporate buyers in supporting clean energy projects, leveraging a really important study that REsurety has completed recently. We also want to raise awareness around the upcoming greenhouse gas protocol consultation period and let you know how you can get engaged, learn more about the process, learn more about how you can participate. And importantly, support your understanding of the topic. So we have time set aside to answer your questions at the end of the session. Next slide, please, Carrie. CEBA and all of our members are committed to strict compliance with federal and state antitrust laws. So as part of that commitment, I'll remind everyone here that this discussion will focus on market trends, data, and best practices, not on any company's specific or future business plans. So please refrain from sharing or discussing in the chat any competitively sensitive information, including specific prices, pricing strategies, contract terms, individual company information, your plans, strategies with suppliers, etc. Our goal is to explore insights from the REsurety study and to talk about the broader market context for corporate clean energy procurement in a way that supports transparency, innovation, and healthy competitive markets. So with that, let's dive into the discussion. CEBA recently commissioned a study with REsurety that provides some of the clearest evidence yet of how crucial corporate buyers are to getting clean energy projects built. And the data are very striking. The analysis found that projects with corporate offtakes were less likely to face financial distress, with long-term investments from contracts such as VPPAs, virtual power purchase agreements, and power purchase agreements, and with unbundled REC purchases. Without corporate commitments, many of these projects simply would not get financed or built. And over the past decade, corporate buyers have been responsible for over 40% of new clean energy capacity in the US. That's an extraordinary number. Next slide, please. That equates to more than 120 gigawatts of large-scale clean energy commitments from voluntary corporate customers, more than 240 companies. So today and going forward, this matters more than ever. Power demand in the US is climbing faster than we've seen in recent history, driven by the growth in AI, electrification, and US manufacturing. So today, we'll explore what the data from the study tell us about the state of corporate procurement, what risks we face if this great momentum in this chart slows, and what it will take to keep energy deployment on track in the era of this new rising energy demand. So with that, I'm thrilled to be joined by Robert Kane, Senior Director at REsurety. Robert, as we turn it over to you, could you share, we're looking forward to hearing from you to share more about the study's findings and what they mean for the market.
Thank you, Sarah. Thank you, Carrie, and thank you all for joining today. Carrie, if you want to just jump to the next slide here, and maybe one more. Perfect. So the story that we're talking about here today is not a new story, right? I think we've all kind of heard this, logical path of reasoning that energy prices are variable, they go up, they go down, regardless of sort of what generation source you're talking about. But because energy prices are variable, that means that clean energy projects have variable revenue. Sometimes they'll be able to sell the power they produce at high prices. Sometimes they'll have to sell it at lower prices. And that variation in revenue means that it can be difficult to get project financing, right? The bank looks at these projects, looks at the variation in revenue and says, I'm not sure you're going to be able to repay your loan every single month. That's where corporate offtake comes in. It sort of stabilizes or guarantees revenue long term. That means that these projects are always going to be able to sell their power and they're always going to be able to repay their loans. That kind of enables the financing and gets the projects built. Again, that's not a new story. That's not a story that we're introducing for the first time here today. What we're doing is trying to put some data to that story, right? That story sometimes and more recently has come under a little bit of questioning. We get some questions like, hey, are these corporate offtakes just sort of subsidizing developers, or would these projects get built anyways? What we're trying to do here is put data to these sort of logical statements and make sure and prove that, like, hey, this corporate offtake really matters and is really important for all the reasons that Sarah described in moving the energy transition forward. So the way that we've done that is that we've looked at over 250 operating projects throughout the US. We focused on ERCOT, MISO, and PJM, 3 of the 7 ISOs in the US, with the idea that those represent sort of 70% of the projected offtake for corporates in the coming years. And we will go into more detail here in terms of our exact methodology, but the idea here is that we'll look at, for all of these 250 projects that are currently in operation, how would they have done in a merchant condition, so without corporate offtakes, versus how would they do with offtake? So would they have survived in a merchant setup? Would they have survived the swings of the energy price market? Or did they need corporate offtake to survive and therefore get built in the first place? So we'll step through kind of each of these chunks of this storyline here. Go ahead, Carrie, thank you. So the first piece is just the variation in energy prices, right? And again, this is a function of all energy, all electricity. It's not a function of just wind and solar, whether you're producing your electricity within wind and solar or with gas or with coal, the price that you can sell it for varies by time of day and by month of the year. So what we're showing here is a 12-month rolling average of price. So it's already muting that sort of intraday or intra-hour or intra-month variability in price. But you can see some really big changes and some really big trends in energy prices, right? So if we look at PJM, that's kind of the one that stands out at the top of the curve here in the orange. You see the same pattern across all 3 ISOs that we're exploring for this study. But PJM is, higher prices in general and therefore a little easier to discuss. If you look at 2020, we see a big drop in these prices, right? That on average over this, decade that we're looking at here, prices have averaged maybe $30, $35 per megawatt hour. In COVID, when demand was down and factories were shutting down and people weren't going into the office, that dropped prices, less people looking to use power, and therefore the price drops. That was down close to $20 in PJM over that portion of time. In 2022, things swung the other way, right? People were coming back to the office and gas prices were really high. There was the start of the Russia-Ukraine war, so a shortage of gas, relatively speaking, that pushed gas prices up. And given that a large part of the electricity generation fleet in the US is gas powered, that pushes up supply costs and pushes up the price. And then you see in 2024, those prices coming back down towards that sort of $30 per megawatt long-term average in PJM. Again, that's because the gas prices are coming down and because the sort of temperatures in the winter have been a little bit milder. People don't need to use as much power for some of these periods. All of this to say, there's a lot of variation here, right? So if you built a project expecting to get $30 per megawatt hour, and then, over this 2020 period from maybe 2019 to 2021, your prices would have been down closer to $20 per megawatt hour, and that's a third of your revenue sort of out the window. So that's the sort of variation in energy price that underlies the change in revenue for clean energy projects. You move ahead, please, Carrie. The question then becomes, how do those changes in prices impact projects? So what we're looking at here is one of the 250 projects that we looked at for this study and the simulated financial performance of that project. So the green line here is free cash flow of the project over time. Free cash flow is how much revenue the project makes minus the operating costs of the project minus their debt service costs. So let's walk through the assumptions that we made on each one of these three. And as a reminder, we're looking at 250 different projects here, right? So we're trying to make some assumptions that work across the board and that work sort of from an outside-in view. We're not going to know exactly the operating costs for every one of these 250 projects, and we're not going to know their exact debt service payments, but we can make pretty good estimates that let us look at this group as a whole. So for revenue, we can calculate that pretty directly. We know the historic generation, at least within EarthGOT, we know the historic generation. And in the other two ISOs, we can use our sort of model generation to say, based on how much the sun shone and the wind blew, how much energy were these individual projects producing. We also know the historic price. So we can then take that generation, multiply it by that price on an hour-by-hour basis, and calculate the revenue that this project and the other 250 made over their operating period. For operating costs, we've just made some sort of standard industry assumption. Operating costs are a relatively small part of the picture for renewables projects for wind and solar. Most of the financial costs for these projects are upfront capital. So the operating is relatively small, but we're just using sort of industry standard assumptions across the board here to take a bit of a haircut of that revenue for how much it costs to run the plant. And then the final piece is how much do they have to make in their debt payments, right? So because a lot of the cost for these projects is upfront capital cost, typically projects will take on a pretty high percentage of debt to finance the project and then repay it with the revenues from the project over time. Now, a bank will have what's called a debt service coverage ratio. So how much more revenue do you need to make on average than the debt payment to give the bank confidence that you'll be able to make those debt payments? That debt service coverage ratio, or DSCR, varies a little bit, but is usually around 1.5. So your revenue needs to be 50% higher than your debt payments. This is analogous to, how much of a loan the mortgage company is going to give you from your home. They're going to look at your revenue and say, hey, what percentage of your income am I willing to give you as a loan? So we've set that DSCR at 1.5 for every project to say, different projects are going to make different amounts of revenue based on the megawatt capacity of the project, so on and so forth, and the price in the ISO that they're located in. But all of these projects, we're saying, have a debt service coverage ratio of 1.5. And then the last assumption we've made here is defining financial distress, right? So what we're trying to look at is, when does a given project run into trouble if it's selling its power into the merchant market, if it doesn't have offtake? Now, projects know that prices are going to go up and go down, right? So in the good times, they're going to save a little bit of money so that when the lower price periods hit, they've got some reserves or some coffers that they can draw upon to continue making their debt service payments. So we don't want to say any single month where your revenue is below your debt service payment is going to be an issue. Instead, what we've defined is a 2-year period, a 24-month period. So we've said if for 24 months straight, your revenue is below your debt service payment, and therefore your free cash flow is negative, then you're in financial distress. Then you've had 2 years of being in the red, your coffers are going to be exhausted, and this is a project that's going to be in trouble, and therefore a project that probably wouldn't have been built without offtake. So if we look at this particular project on the left, again, the green line here shows just how variable that revenue is over time. And then the red bars here show the periods of financial distress. So in that sort of 2018, 2019, 2020 period that we were looking at previously, where energy prices were relatively low, the project would have gone into a sustained period of financial distress here. And then at the right side here, the graph kind of ends in 2023 because this is the beginning of that 2-year rolling average period. So starting in 2023 brings us to 2025. But you can see the project, dipping back below that line again. and having another period of financial distress, as it were. So that's the kind of concept of how these variations in revenue sort of potentially hurt these projects and how we're defining that in this study. If you can go to the next slide, Carrie. So then the question is sort of high level, how does corporate offtake work? We'll go back to the specifics on an individual project by project basis quickly here. But at a high level, just want to sort of level set on what we're considering. These PPAs, power purchase agreements, and RECs, renewable energy credits. These are the two main ways that corporates and any other off-taker support clean energy projects. So a PPA essentially flattens the revenue curve here, right? So you see that sort of green theoretical version of the revenue curve we were looking at above. And then a PPA locks in a revenue for the developer and says, I will pay you a fixed price, let's say it's $20 or $30 per megawatt hour for every megawatt hour that you produce. And some days you'll produce more than others, some months you'll produce more than others, but it won't vary all that much, and I'll pay you a fixed rate for that energy. That removes all this variation in revenue that's driven by the variation in energy price. It locks in revenues for the developer or for the operator, and it unlocks financing. The other offtake option is RECs. So these work slightly differently. They don't mute the variation of the revenue curve quite as much, but they shift it up. So it means that there's an additional diversified incremental source of revenue that's stable. So when those low price energy periods do hit, there's another source of revenue that the project can turn to help weather the storm, as it were. Okay, if you can move forward. So now let's take this back to that same project, right? This green curve is the same one we were looking at before for one of our 250 projects. The blue curve is what a PPA looks like for this project. So we have to make an assumption here on what the PPA price is, right? Again, for all 250 projects, we're not going to know the details of the PPA terms that they may or may not have signed. But the way that we've done this is that we've said, we set the net revenue equal. The idea, so if you took the total revenue that the green curve would have made here, so how much money the project would have made in the merchant market, that's equal to the revenue from the blue curve here. We did this intentionally because we don't want the PPA in the study to be serving as a subsidy. We don't want the offtake provider to be paying above market rates, as it were. We don't want to get into the territory of anything like that. So we're saying you're making the project is making the same amount of money. It's just making it through a stable PPA, through stable offtake, rather than through the variable merchant market. We're only showing the PPA on the plot here, but the sort of equivalent assumption that we've made we also need to make an assumption for a REC price, right? The REC price that we've used for this study is $2.74 for a single REC or a single megawatt hour. That's based on the historic prices for national green E-RECs. Those are kind of the national standard. They're sort of widely used, widely available, and they're fuel agnostic, meaning solar, wind, so on and so forth. Next slide, please, Carrie. So then the question becomes, we've been looking at one individual project here. How does this trend hold as we start to zoom out into the 250 projects here? So this is not 250 projects, this is only 25 projects, but this is, instead of one PJM wind project, this is 25 wind projects in PJM. And a few things to sort of call out here. So first of all, if you look at all the different green lines here, you see the same trend throughout. So every project is having this high variation in merchant revenue if they don't have offtake. And you'll see that for a lot of these projects, the green line is dipping below that black line. So that's when they're going into this period of financial distress. So there's a lot of these merchant projects that would struggle without offtake. You'll also see these blue lines varying a little bit, right? So there's a little bit of a wiggle in the blue line because the volume of generation differs, like we talked about. So it's not guaranteeing that we're always going to pay you $200 a month for whatever you produce. We're going to pay you $20 per megawatt hour, and you may produce slightly more or slightly less megawatt hours month over month. That said, the variation in the blue line is orders of magnitude lower than the variation in the green line. So the variation in revenue and prices in clean energy is not a function of the generation technology. It's a function of the market prices, which are true for all generating technologies. And then the last thing you'll see is there are some of these blue lines that dip below the black line, right? So in that kind of second row down in the center there, you'll see a blue line that dips below the black line. That's because some of these projects have what's called nodal basis. So we've made the assumption that all of these PPAs are settled at a hub level, meaning a collection of different nodes and the price that is set at that hub. That's a sort of standard and the most common way that PPAs are written and settled. But that means that there's remaining risk to the developer, to the operator, the project owner, of what's called node to hub basis. So there's a price at the node for the project itself, and there's a price at the hub, which is a collection of nodes. And there'll be times that the price at the node is lower than the price at the hub. So if that's the case and a project sees a sustained period of basis, then that would be a time where the PPA revenues would actually begin to drop a little bit, that they'd get a certain amount of revenue from the PPA contract. That wouldn't be enough to cover what was happening at the nodal price. And we can talk about that a little bit more. But just want to flag that later on, we're going to see that PPAs don't solve every single case. And this is an example of, when they don't quite solve every single case. Okay, next slide, please, Carrie. So then the final piece here is, okay, that's 25 projects. What about the 250? How many of these projects, see financial distress in the merchant market, and how many times, does offtake improve that? So the green bars that you see here, that's the merchant market. Those are the green bars that we were looking at, the green lines that we were looking at on the previous curves. So anytime, and it's representing how many of those green lines went below those black lines, and how many of these projects were in financial distress. So the left three chunks here are the different markets, and then the right side is the total. Maybe we'll just focus on the total for now. We found that 58% of all of these 250 projects saw financial distress. So that means essentially that 58% of these projects would not have been built without offtake, because people know the energy market's variable. They know these projects are going to see price swings. And as long as you're able to forecast the price reasonably well, then you'd know that they're not going to survive without offtake. That's a huge chunk of these projects that wouldn't happen without offtake. And the question is, how helpful is the offtake, right? If the offtake's not doing anything useful, then it's not going to help the projects get built. The orange bars, here are the impact of the RECs. So again, this is kind of shifting that revenue curve up. And this is with that assumption of a $2.74 REC. What we're seeing here is that 28%, basically 30% of those projects that did see financial distress would not have seen financial distress if they had REC payments in place. And then the blue bars here are the impact of PPAs. So this is saying for all of those projects, if they'd all signed offtake, how many of them would have seen financial distress? So over 90% of the ones that saw financial distress in the merchant market would not have seen financial distress if they had an offtake agreement. There are that sort of remaining 5%, which I mentioned above, where there's sort of node and hub basis issues that mean a PPA isn't a perfect silver bullet. But we're down to only 5% of projects that are going to have financial distress if they have offtake in place. And that's the key part to sort of unlocking this financing, that if you're a bank looking at this picture, all of a sudden you're saying, hey, these projects have stable revenue in place. It's a very low, chance that they're going to see financial distress, and therefore I'm willing to make that loan to get this project built. So if we zoom back to that sort of initial story that we were trying to put some data to here, we were saying that energy prices are variable, and that means that revenue is variable, and that means it's hard to get projects built. What we're saying here is 58% of those projects wouldn't have gotten built. The second part of that story is corporate offtake stabilizes that revenue and gets those projects built. We're saying that over 90% of those projects that wouldn't have gotten built would now get built with offtake in place. So this is, again, putting data behind that story that I think we've probably all heard before. The corporate offtake is critical and crucial for getting these clean energy projects in the ground and going and supporting the clean energy transition. Carrie, happy to take any questions that you've got or any questions that may have come through from the webinar.
We're going to turn it back over to Sarah for a moment before we open it up to Q&A. Thank you.
Yeah, I just wanted to thank you, Robert, and thanks to the entire REsurety team who was significant in bringing this study to life from the modeling to the execution. So what I heard, and I think kind of the three things that coming back to what matters is that these renewable energy projects face significant upfront capital costs. They have to be paid back with future electricity sales, which end up being variable because electricity prices fluctuate naturally in the market based on energy mix, weather, etc. And that we've seen now corporate clean energy buyers for 10 years plus entering into long-term contracts, often 8 to 15 years, depending on the contract time, to purchase future energy for a fixed price through PPAs and VPPAs, and that creates stability, a predictable, stable revenue source. And that concept basically then allows loan providers to have some certainty. So a loan provider knows when the future electricity, who will buy that future electricity, what the price is, and they will get more favorable terms. So the project pencils out. So it looks less risky and it comes to life. So I'm really excited about what this study has defined. As you said, these are our concepts and information that we've long known and said, but haven't had the evidence. So this is really significant for having such a large portion of projects now having been modeled out. So also want to signal that the entire study, the full study from REsurety is available on SEPA's website. Please do check it out. It has a lot more details around the assumptions that Robert walked through around the modeling and all the details there. So that is available on our website. So with that, I'd like to turn it over for questions, if anybody has any. Harry, maybe I'll get to the public consultation in a few minutes after we get in, if we have any questions.
Great. Well, I'm going to go ahead and kick us off with a few questions, as is my right as facilitator to do. And so in this, Sarah, I'm going to ask you one first. So the study makes a clear case that corporate demand is the backbone of clean energy deployment. And so I'd like to kind of hear, based on the findings from this study, what do you see as the biggest risk if corporate procurement momentum slows, and what could help sustain or grow it over the next 5 years?
Sure, yeah. Great question. So as I showed on a previous slide, corporate procurement has been a very significant part of clean energy transition in the US and increasingly outside of the US as well. And so the biggest risk if corporate procurement momentum slows is that we simply won't have enough, there won't be enough build of new clean energy fast enough to meet the growing demands. So electricity demand is expected to grow between 35 and 50%. And that's, a pretty significant number. Sectors like technology, manufacturing, healthcare, and retail at the same time are making these bold commitments to diversify, what's the mix of things on the grid. So the data in the study show that corporate buyers are often the difference between a project getting financed or not with those long-term commitments, as well as with unbundled reps, which is a very significant finding. So essentially, without the corporate commitment, without that demand continuing, developers will be less able to advance new builds. There's a risk of higher costs and significantly slower progress towards decarbonization. So I think part of the question was what's needed to maintain that. So I think, several things. SEBA is very focused on making corporate participation in the market easier, more flexible, supporting that transition. And importantly, corporates need to be able to recognize the actions they're taking in decarbonizing the grid. So we know that buyers are already experiencing procurement challenges in many markets. Certainly recent policy conditions in the US have not made that easier. And tightening conditions mean that we need to continue to see incentives. So SEBA, one of the things that we're focused on in this study and or in this webinar, and why we're highlighting it, is because we recognize the importance of greenhouse gas accounting in how corporates are accounting for the actions that they're taking. And so we'll get to the details in a few minutes, but we are very focused on encouraging everybody here on the call, as well as all of our members, to participate in the upcoming public consultation period for the Greenhouse Gas Protocol Scope 2 standard, which will be coming very, very soon, any day now. And so we're really focused on helping you to be ready to engage in that process.
Now, Robert, I'm going to direct a question to you as well before we start turning to some of the questions we're getting in the chat and Q&A. So looking at everything that you shared this afternoon and based on this research, can you elaborate maybe a bit more on how using a higher REC price might change the impact of RECs?
Yeah, good question. So we picked that $2.74 price just based on a greenie rec. There are higher priced recs out there, right? So PJM tri-qualified recs, for example, come to mind as something that has typically a much higher price point, and therefore projects in PJM, for example, could be selling recs at a much higher price point. That would increase the impact of those recs, right? So we said for that $2.74 rec, then that was a 30% decrease in the number of projects that we're seeing that financial distress. If we increase that to $7.50, so 2 or 3 times the amount, then it goes all the way down to 20% of projects in financial distress. So that was, I think it was 60% down to 20%. So percent reductions in percents in the first place is always a little confusing, but not quite down to that PPA number, which was all the way down to 5%, but even more impact and even more reduction in the number of projects that saw distress.
Now, turning to a couple of the questions I'm seeing come through the chat, and y'all online, feel free to put the majority of your questions into the chat. I know we have a couple in the Q&A as well, but feel free to focus them in the chat. We received a question: have there been any studies outside of wind and solar, noting that the projects highlighted here have us focus on wind and solar particularly?
So we were focused on wind and solar because those are the two that make up the bulk of corporate offtake to date. The same concept applies, right? That, as I said, the variation revenue here is not because it's a wind and solar project, it's because it's a generating project. So if you had a geothermal project, or if you had a carbon capture project, those are projects that need offtake in just the same way as wind and solar do. And those projects have just the same impact or benefit from offtake as well. The exact percentage is then going to be a function of the operating costs of those projects, right? Which maybe have higher operating costs, and therefore the debt ratios look a little bit different. So I wouldn't want to use the same percentages for different technologies, but the same concept that corporate offtake is critical to getting those other clean energy projects built holds.
So what I hear is there's always interest in additional research coming down the pipeline across the full variety of projects. So who knows? Maybe we'll get some more of that down the road. Then turning to the next question I'm seeing: what do you see as the largest obstacle/risk to increasing corporate demand?
Sarah, do you want to take that one? I'm happy to as well.
Yeah, I'm happy to jump in on that. And then would love to hear your response too. So I think, Anna, I think you posed that one. It's a really important question. I think one thing to note is that, market conditions have been tightening, and companies are continuing to contract for clean energy, even in these tightening conditions. So we've got some really creative, innovative members, both on the buyer and all sides of this this massive puzzle who are trying to figure it out. One of the risks, though, that corporates do face is certainly around receiving appropriate recognition. So, one of the things when we ask our clean energy customers, if what things are keeping them up at night, I think uncertainty is one of the buzzwords of the year, probably, and certainly uncertainty in the policy regime, as well as the corporate accounting, corporate greenhouse gas accounting are two big things on the front of people's minds. So SEBA continues to focus on ensuring that the accounting standards recognize the importance of corporate demand and corporate action. And that holds true also in the policy space. So I think decreasing options or decreasing recognition are two big concerns. And so we're very focused on continuing to have multiple pathways to decarbonization and appropriate recognition for that. So that's one thought. And Robert, do you want to add anything to that?
Yeah, I would say one of the things we hear a lot from corporates, just starting to get involved in offtake, is an understanding of the risks, right? And hey, I don't buy energy like this today. What risks am I signing up for? So on and so forth. That's part of why we're doing this research and why we're holding this webinar, right? Is to help people understand both the impact that you can have and what that looks like long term. So there's a bunch of different ways that you can make it not a risky investment in terms of the terms that you use when you sign the PPA and how you might want to hedge it on the back end. All these different things mean that it's something that's accessible to a bunch of different companies with a bunch of different size balance sheets. And I think that's not something that everybody immediately sort of realizes or thinks of, especially with the PPAs. So that's one that I think people are sort of increasingly realizing, and why we think these, super impactful, if you want to call them that, PPAs are just going to keep growing over the coming years.
Getting a couple additional questions coming through the chat and even some direct messages. Here's one that promises to be interesting. Why are traditionally fueled technologies like gas and coal able to be financed and built even in the face of volatile energy pricing if renewables are not?
Or could you repeat it? Or you said
Yeah.
gas and coal?
Why are traditionally fueled tech like gas and coal, why can they be financed and built even in the face of these volatile energy prices that we're outlining when renewable energy has a difficulty?
Yeah, so part of the answer is that the cost structure for thermal generation is different than it is for clean energy. So clean energy is pretty much all upfront capital with very low operating costs thereafter, meaning that once you've built a solar farm or a wind farm, it's pretty much free energy from there. Your operating costs are really low, whereas thermal plants, A, you have to pay for the fuel, and B, the operating costs are a lot higher. So a smaller percentage of the capital that you have to commit for these projects is due upfront, and a larger part of it is sort of operating cost, as it were. And therefore, the financing costs or the financing burden for clean energy is a little bit higher because they do have to front all of their capital, essentially. So that's why it's sort of a bigger impact to the clean energy projects than it is to thermal generating projects.
It's a long-standing question I've had, so I appreciate you answering that so concisely in a way that even I could understand. Now turning to some of the questions from our Q&A. One is curious why the 2-year time frame was used versus 1 year to measure financial distress. Would a 1-year view change the conclusions materially?
Yeah, so there is no dictionary definition of financial distress, right? Some projects would probably hit financial distress before that 2-year time. We wanted to be conservative here, right? We definitely didn't want to say it was only 1 week or 1 month. Sort of talking with the market, talking with financiers, so on and so forth, that 2-year time frame felt like seemed to be the conservative one. If we used 1 year instead, that would increase the impact of offtake, right? So more projects would hit financial distress sooner, and therefore there'd be even more impact from offtake. So that 58% or 68% of projects that saw financial distress would go up if we used 1 year as the time frame instead of 2 years as the time frame.
Great. Another question I'm seeing in the chat, do you have data about whether adopting hourly matching / RECs increase or decrease the percentage of projects that experience financial distress?
Yeah. So hourly matching is an accounting approach, right? So this is something that would be used on the offtake side for folks to say, which RECs do and don't count for my load usage. That won't directly affect the generator and therefore won't directly affect, whether they're going into financial distress or not. It could potentially change the price of RECs, right? So if certain RECs at certain times of day become in shorter supply, the price for those might go up, and therefore we'd be potentially seeing a different price than that $2.74 price that we were talking about before. So then you'd just be moving relative to that price. If the price of RECs went up, then it would have an increased impact of reducing the number of times that these projects saw financial distress.
And Carrie, if I could add to that from a slightly different perspective, thinking about how corporates may choose their procurement strategies. This is something we spend a lot of time discussing and supporting energy customer members of SEBA and thinking through. And so strategies like the VPPA, the Virtual Power Purchase Agreement, and specifically power purchase agreements, there's a kind of a specific thought process that goes into corporates as they think through that. A VPPA is a very powerful, sorry, that pun was going to come up at some point today, a very useful approach for a company that wants, has a load, a disaggregated load. So they have energy demands maybe across several geographies that individually don't equate to enough to maybe invest in a new clean energy project. And so the strategy of a VPPA gives you a lot of opportunity to look at a scale, so they can engage in projects that are 50 to 100 megawatts versus maybe 10 to 20 megawatts, which offers just very different solutions for corporates. It also allows for engagement in bringing new energy online, which is very useful for decarbonizing the grid. So I think part of it, as we think about that question, the hourly matching may or may not work with certain corporate energy strategies because of that of the disaggregated load, or because the retail solutions are not available in the market that where the load is operating. So, the long-term 24/7 clean energy grid is certainly what SEBA is looking for. We want to see that the entire grid be clean every minute of the day around the world, which is amazing. That's the end goal. But I think that is something to take in mind as to what does each company have available to them as a tool in their toolbox when they think about how they're going to achieve decarbonization.
Absolutely. Thank you for adding that additional color and content around that, Sarah. Looking at our questions again. So thinking at looking at the time frame that y'all used for this data collection and acknowledging that, we've had a lot of unique events over the past couple years, whether that's been the building up of several global wars or the pandemic. How did y'all ensure that the data you were using for this project was future-proofed and applicable for evaluating the impact of demand moving forward?
Yeah, so there's definitely, I think to the question, there's definitely a pretty universal dip in the performance of these projects or an increase in financial distress during that 2020 COVID period. There's also a pretty universal increase during, the high gas prices when Russia-Ukraine started, right? So there's a lot of, exterior one-off events that influence these things. I think if we went back and looked at that placemat plot of all the projects again, I think we'd see a lot or almost all of them coming back down again in 2024 and hitting financial distress again in 2024. So it's not a matter of, hey, this only happened during COVID and these projects are great otherwise. It's a function of like, hey, there was a bad time, there was a good time, there was another bad time. The other point here is like that plot that we showed on price variation, that's a 12-month rolling average, right? So it hides the change that you get month over month. It hides the change that you get hour over hour. If you looked at energy prices in terms of, variation, like a coefficient of variation on a statistical basis, they're one of the most variable commodities, right? So I think people think about Bitcoin as something that's really variable. Energy prices are more variable than that if you just look at coefficient of variation like hour to hour. So it flattens out a little bit over time here. But it's not a function of like, hey, energy prices are stable except for COVID. It's that, there's a lot of different things that feed into the energy supply. Any one of them can have an impact on price, and they do have an impact on price on both the small scale, like the hourly level, and on the larger scale, the macro, the annual level. So I think taking that decade period that we showed there, and taking the full operating life of all of these projects was our way of saying, taking as big a sample as we could of the variation in these prices. So some of the 250 projects have only been operating for 6 months, a year and a half. Some of them have been operating for 5, 6, 7 years. We didn't discriminate when we picked them. So we have a varying range of sample size, and there's a bunch of them that have experienced financial distress since COVID that came online in 2023, for example.
Now we've got one more question in the Q&A that I want to answer before turning back and sharing some of our upcoming SEBA efforts. So final question here. What does the research suggest for situations where REC payments are bundled into PPAs? If fixed RECs are bundled into a PPA, would it further reduce distress from the 92% you noted?
Yeah, so we had intentionally not included a REC price in the PPA, right? Because we wanted the PPA to be just a pure, to match the revenue from selling the energy. So it's purely on the energy and not for the environmental attribute. So it's a good question of, if you included the RECs in the PPA, that would essentially increase the PPA price, and it would combine the effect of the PPAs that we showed and the RECs that we showed. So yes, it would further decrease the number of projects that saw financial distress below that 5% and probably approaching 0. So in reality, PPAs are signed both for power price, for the value and the benefit of getting the energy, as well as the value and the benefit of getting the environmental attributes. So those two do get combined for even higher impact. But we thought it was important to show not just a pure PPA that matches the revenue, to show like this is not anything approaching a subsidy, and it still has a huge amount of impact in getting clean energy built.
Well, we made it through our questions, which I'm quite impressed that we were able to do. So I'm going to briefly share my screen again, and y'all bear with me as it navigates the different window modes. Is this showing properly on your end, or do you need to switch it?
It is. You're good.
Wow, master.
Well done. And thank you, Carrie, for moderating that Q&A. So just to tie this study to what's next for SEBA, SEBA would like to ensure that corporate demand for clean energy continues to be recognized in the Greenhouse Gas Protocol scope 2 revisions, as I mentioned before. The existing protocol methodology published back in 2015, which is crazy because I remember when it came out, is now under revision. And so there's a revision being prepared for public comment, drafted by the technical working group and the modifications from the Independent Standards Board. We expect this new draft to be out in the next few days or so, sometime in October, I believe, is the expectation still. And so we're encouraging you to participate. Everybody on this call likely has a voice in this process. And so we have several webinars and toolkits prepared to support both SEBA members and the public. So if you're not a member, please still continue to participate. The items that are asterisked here in the list will be open to the public. And so the next immediate one is next week on October 23rd. We'll have a webinar with Resource, which is a EU-focused organization that has similar mission as SEBA. And they will be talking about the changes in the EU regulatory space and how that may impact carbon accounting as well. If you're a SEBA member, definitely join us for our bi-weekly office hours. And if you're going to be at the Verge conference at the end of this month, join us for a workshop on Tuesday, the 28th morning, where you can also learn more. So there'll be lots of resources, toolkits, webinars coming out. Our website, cebuyers.org, is the best place to find links to all these things. So we really do encourage you to get engaged, educated, and involved in this important process over the next few weeks. So with that, Carrie, again, thank you for moderating. Robert, thank you to you and your team, the many folks who supported developing this study. And I'm really excited that we now have, concrete evidence of how crucial energy customers are in the clean energy projects. Check out the full study. Hope to see you in future engagements. Take care and happy October.
Thank you, everyone, for attending today's webinar. We appreciate your time, and please feel free to reach out to me with any questions afterwards. Have a great rest of your days.